Hey everybody, it's Brian. Thank you so much for being here today. We're back for our next lesson in Trading 101, and today we'll be talking about the market information, so how we get the information that we're using to view the markets and read the markets, and also the different trading types so that you can understand a little more about different ways to approach the market from a trading style and start thinking about which one might be right for you. All right, so let's go ahead and get into it. First things first, I always put up a disclaimer to let you know and remind you that I am not a licensed investment advisor, and I don't pretend to be one here. I'm just showing you information, methods, tools, things that I've used over the years and learned through the years. One big thing to always keep in mind, I'm not going to harp on this, but do remember, trading involves risk. There's a huge potential for reward, but there's also the flip side of that, which is a big potential for loss. So only trade with money you can afford to lose. That should be true risk capital, as we've discussed before. All right, so what's our goal for the day? Well, my first goal, as always, is to keep it short, about 15 minutes or less. And today we're going to talk about how we view market data. We'll talk about charts and what the information is that we see on charts. We'll talk some basics about time frames. We'll discuss measures of movement, and then we'll talk about the different trading types at the very end so you can start thinking about which one best fits your personality. And then from there we'll wrap it up and be ready for the future exercises. All right, so first things first, market data platforms. Where do we get the market data from? Well, there's a couple different sources. There's obviously free sources. There's free services out there. I like to really use one called finviz.com. Finviz.com. It's the one you see in the background there. It's got the little boxes. And I use that to get a really quick snapshot of what the market's doing, how it's performing. It provides really nice, clear, concise, easy to read market data. Just to get a quick snapshot. And if you want to learn more and see more of what's going on, you can actually roll your mouse over any of those instruments, and you'll be able to see the chart behind it so that you can see what the actual movement looks like from a chart pattern perspective. As far as charting services go, most brokers are going to provide you with one. Some great charting services are NinjaTrader, TradeStation, Traders Workstation, which is through Interactive Brokers, MetaTrader, which is one of the most widely used charting platforms out there and trading platforms for Forex trading. And then there's TradingView, which is a newer one on the block. It's an HTML-based, web-based trading platform, trading and charting platform, which integrates with a lot of crypto brokers, which is really nice. All right, so those are the platforms that are out there. As you start using one, whichever one you choose to use, you'll find that information is displayed to you in probably a candle or a bar, something like is on the screen right here in front of you. What that information is showing us is how price is moving over a specific time period. Every one of them is showing us the price at open, the high, the low, and the price at close. That's what it's displaying to us. Now let's pop over to a chart and have a look at a live chart here so you can see what I'm talking about. So as we see, we've got a chart here in front of us, and it's got some red lines and green red candles. These are called candles, by the way. What I'm showing here on my screen. Let's make this a little bit bigger if we can. Oh, I don't want to do that. Let's see if we can make it bigger this way. So each of these things that's displayed on my screen, this is called a candle. One of the most common ways of looking at the market is with candles. So you'll see a lot of information about candle patterns and different trading techniques based around the way candles or the price has been moving over time. But candles, there's another way to look at it called a bar, which is here. These things are showing us the information of how the market has been performing over a certain time period. So it's just simply showing us the open, the high, the low, and the close. So if it's a green or a blue candle, it means that it's closed higher than it opened. If it's a red candle, it'll be showing us, or a red bar, it'll be telling us that it closed lower than it opened. So on the bars, you can see the little left hand. See if I can make that a little bit bigger here. On the left-hand side, so if you have a bar, so the little branch out to the left-hand side here is showing us where it opened, and the branch to the right-hand side is showing us where it closed. So in this case, like for this red bar right here, it opened over here, it closed lower, so that's why it's red. On the blue ones, or I guess that's kind of turquoise in my case here, green ones or blue ones, it'll be showing you that the price closed above where it opened. But at any rate, what the information is showing us is high, low, open, and close for that period of time that we happen to be looking at the information displayed for us. And there's a lot of different patterns that different chart types we could use. We could just use a line, which actually doesn't show you the high, low, open, and close. It takes out all that information and just shows you the movement of that specific currency you've got, or specific instrument. You've got the Heikin-Ashi candles, and these are an average. Basically, these remove some of the noise from the marketplace, and they show you the average of how things have been moving, which is a great way to make trends a little bit more visible if you're not able to recognize or read what the trends are, how they're working using just a regular standard candle, which is what we're seeing here. So anyway, a few different ways to look at the market. We'll dive into more about the different candle types. I use standard candles or a standard bar, depending on what I'm trading and how I'm looking at things. But it's usually a standard candle or standard bar is what I'm looking at. And this is simply displaying for us, as I said, high, low, open, and close. It's the same for every instrument, which is why, when you look at a stock chart, you'll see something high, open. You'll see something that looks like this. If you're looking at an oil chart, it looks like this. If you're looking at a cryptocurrency chart, it looks like this. They all look alike. And that's helpful because now information is displayed the same way no matter what market you're operating in. It's showing the same information. All right, so let's pop back over here. The next up is talking about time frames. So we know what a candle or a bar is showing us. It's showing the information over a specific time frame, but we can look at that information over a 1 minute period, a 2 minute period, a 5 minute period, a half-hour period, a 4 hour period, a 1 day, a 1 week, a 1 month. So obviously the candles are going to show us different things depending on the period of time that we're looking at. So for instance, right now this is a 30-minute chart, but I could change this to show me information on a daily level. So what's happening, I can go out and see a much longer term and see how things have been performing from a higher level view of the marketplace. I could scroll out even further and have a look here at, instead of daily, I could look at a 1 week, look at candles on a 1 week basis and see how things have been performing and see what it's looking like. That's helpful to be able to see trends developing. So we're able to look at this in a variety of different information. And again, looking at time periods, we're going to get more into this as we start talking about the different ways to approach the market and some very basic trading strategies that you can begin applying. We'll talk about some what we call top-down analysis, which is looking at the market that we want to trade, or the instrument that we plan to trade, and doing some top-down analysis by looking at long-term charts and then working our way back into shorter-term charts that we might want to trade from on an intraday basis. So we'll get into more of that as we get further down into the actual development of a trading plan, of a trading system. But ultimately, the goal of this is just to explain the very basics, which is how we're seeing the market. So how is the market data displayed for us visually, graphically? How do we view it on different time frames, which we've just covered here? All right. Next up is the type of movement. So we'll use terms, depending on the market that we're trading in, we'll use terms like pips or ticks or points or satoshis if we're talking about cryptocurrencies. All of those things are defining for us the lowest level of movement that we can have in a specific market or specific instrument. So here on the screen in front of us, we're able to see, for instance, the pound versus the dollar. We go out 4 decimal places, and that's called 1 pip. As that changes from the fourth decimal point, as that moves up or down incrementally, that's 1 pip. The 5th decimal place, which many brokers are showing us now, is called a pipette. If we're looking at the futures market, we operate in ticks. So the S&P 500, for example, the E-minis, those are called ticks. So moving from, let's say, 2174 to 2174.25, that's one tick. Each pip value, each movement of a pip in Forex, or each movement in a tick in the futures market has a value associated with it, has a fixed value associated there. And it's important to know what that value is, because it does vary. It varies based on the instrument that we're trading. So in foreign exchange, the pound dollar might have I shouldn't say might, does have a different value than the pound yen on a pip per pip basis. In the futures market, the ticks, the way ticks move, so the S&P E-mini moves by a quarter of a point. So each tick is 1/4 of a point. A point would be the full movement from 2174 to 2175. That's a point. So the tick movement, it moves in a quarter. But in the gold market, that actually moves in a tenth, in 1/10. So it would go from 0.1 to 0.2 to 0.3, so on and so forth. And that is a tick in the gold market, and that has a different value than it does for the S&P. Again, not something you need to know or worry about right this moment, but just wanting to put down the basics so you start thinking about that. In cryptocurrencies, we go out even further. We go further than those 4 decimal places that we see in Forex, or the 2 decimal places that we see in futures. Cryptocurrencies can go out, 5, 6, 7 decimal places. They can go out very, very, very far, and we're able to trade on those very small increments as price fluctuates up and down. Now, that brings us to the types of traders. So we're looking at the markets. We're all looking at the same data displayed to us in the same way. We can analyze that data on different time frames. We can control our risk by understanding what the value of that incremental movement is, whether it's a pip movement or a tick movement or a point movement, however far we're planning to let something potentially go against us before we close out. That would be our risk. That's the definition of risk, is looking at the entry point and how far this could move against us before we want to be stopped out, and doing the math on what that potential negative movement could equate to. So it's important to understand those incremental movements, what they are, how they're defined. We'll get more into that as we look at the specific and individual markets. But for now, it's important to understand that as well, because when we look at the types of traders might be using or worrying about larger or smaller levels or ranges of movement. So the types of traders that there are, you've got very, very short-term traders, which are called scalpers. Those are traders that are getting in and getting out with very, very, very high frequency. They want to just get in and try to scalp a couple of pips or a couple of ticks from the marketplace and get back out. They're looking at momentum very often, and as they see momentum start to build, they'll take a trade and they'll just go for a couple of little ticks or a couple of ticks or pips, get their profit, get back out, and move on to the next trade. They take a lot of trades through the day. They're very, very high frequency. Those are scalpers. Then you've got an intraday trader, which is kind of the next level up from a scalper. They're not really scalping, but they're still looking at these shorter term time frames, so that 1 minute, 5 minute, 15 minute, maybe even a 30-minute time frame as they're watching the marketplace and making their trading decisions. So they're fairly high frequency in that they may take quite a few trades through the day, but they're not as high of a frequency as a scalper, because they're waiting for certain levels to be hit, or they're waiting for certain confirmations in the marketplace and then taking a trade. They're a little bit more patient, but they are still generally in and out and flat, meaning they don't have any open trades by the end of the day. They're closing out their trades and coming into the new day with cash. Right? So that's an intraday trader. The other type of trader is the longer term trader. These are swing or position traders. And what that means is they're looking at the long-term trends of the marketplace. They're comfortable with getting into something now, knowing that it might move against them pretty considerably, but they're looking at that long-term aspect of what the market might be doing. They're not going to take very many trades at all. They may only take a few trades a year because they're very patient. They're waiting for these larger things to develop and unwind, and that allows them to hold their positions. Whether they're long or short, it allows them to hold their positions for a much longer term as the market begins to work for them. They're expecting certain fundamental things to drive the market over that long period. And again, they use the very big time frames. They're looking at those, dailies, weekly, monthly trends and making their trading decisions based on that, along with the fundamental things that they might analyze in the news for that stock or that economy if you're looking at Forex, or that specific market if they happen to be looking in the futures market. Right. So those are the different trading types. All appeal to different people. All have different approaches, and there isn't any, quote, right answer. The right answer to what type of trader you should be really is dependent on your personality, how you manage risk, how active you want to be, what time frame you can actually be consistently trading in, so on and so forth. So again, there's not a right answer. It really comes down to what's best for you. And that's how we really approach everything in trading. Everything I'll talk about is giving you the information so that you can do with it what you will based on your specific risk tolerance and individual personality. Right? So that is it for the day. We've hit charting services. We've talked about the information that you see on a chart, what it is. We've talked about the measures of movement, meaning the pips, the ticks, the points, and we've talked about the different trading types. So that's it for me today. We'll be back with our next lesson, which we will start talking about support, resistance, identifying trends. All right, have a great day, and we'll talk to you soon. Thank you.